When people ask me what the goal is of a firm like Ares in private credit, it's a very simple sentence: don't lose money. To go back to football, it's a very, very powerful business model. I grew up on Wall Street 30 some odd years ago. I have some unique insight into this. We have the CEO and CFOs of our companies on speed dial. How did we do it?
If something goes badly wrong in private credit over the next, say, 12 months, what do you think could be the trigger?
We don't see any signs today in the portfolios of issues. A couple weeks ago, we reported publicly that our BDC in the US, which has over 600 companies in it, was doing quite well. Companies are growing their profits in the double digits. Credit statistics are trending the right way. So I think we're starting from a good place. The second thing would be that, remember, for something to happen to credit or private credit, certainly equity is the first loss. So a lot's got to go wrong before private credit gets impacted. I think the third thing would be, last year we had Liberation Day, which wasn't fully anticipated in advance. We got through that okay. So I'd say a lot would actually have to go wrong before private credit is massively impacted.
Financial crashes or recession, they are inevitable. They come, they're cyclical. At some point it's going to happen. How well prepared do you think Ares is, and how well prepared are your portfolios to withstand something like this?
It's a great question. When people ask me what the goal is of a firm like Ares in private credit, it's a very simple sentence: don't lose money. And that needs to be battle tested over time through a very, very specific investment strategy. So the way we do it actually starts even before we have a deal. We have something like 100 people in Europe, just to give an example, 7 offices. We talk to 1,500 companies in Europe every year, and we make new loans and investments into 30, 40, 50 of those. So we're very, very selective in terms of what we do. And we say, oh, well, you're selective, but why? What are you looking for? Well, we're looking for companies that are leaders in their niche, that are growing well. But importantly, we have seen before through the GFC, through COVID, through shocks like Brexit or high interest rates, inflation, all these things, what companies did well. So we can actually look at their track record to make that determination. That tends to guide us to certain industries: business services, healthcare, telecommunications, et cetera. So I would say we have a pretty good filter that helps us stay out of trouble even before things start. Then when you look at the types of loans we make, 80, 90% plus first lien senior secured. So if anything goes wrong, we're first in line to get our capital back. Again, it's sensible loan to values. The long-term loan to value in our space going back 10, 20 years is probably 50%, maybe even higher. However, we're currently in a space where we're more like 40 or 45%. So again, a lot of equity underneath our loans. Ares has a team of 25 people in Europe and 50 in the US that monitor our companies very closely. It's their sole job. And one of the great things about private credit is we get numbers from our companies on a monthly basis. So it's, in the public markets, it's maybe every 3 or 6 months, and there's a delay. We have the CEO and CFOs of our companies on speed dial because we tend to be either the only lender to the business or a meaningful lender. And again, time is a real advantage if you can spot issues early and get out ahead of them. And I think the last thing I would say is we have dedicated restructuring experts, people who've spent their lives in this space getting our money back. And what that means, again, if a company's bought for, say, £100, and that would mean that our loan would be, say, 45, that means the value of the business has to deteriorate by 55% and stay there for us to lose £1. Not to say it never happens, but the math is a challenge. So our view, by the way, is if there's an issue, we don't have to get the company back to £100 of value. We just have to cover our loan. And if you look at our long-term track record in Europe, 20 years, US even longer, 25 plus years, our loss rates are like either negligible, 1 or 2, 3, 4 basis points. And I think a lot of that is based on this model that I've just described to you.
How big is the Ares business today, and what areas of the business do you think will grow the fastest over the next few years?
So we just announced a few weeks ago that we're now roughly $625 billion of assets under management. The growth, you're right, thanks for noting it, has been significant over the past few years. As you'll know, we're organized around credit. That's probably 60-70% of what we do. We also have real assets. That's real estate, infrastructure, and digital. We have a secondaries business. We have private equity business. So we do a bunch of different things. Well, one area within our credit department that's growing meaningfully is our asset-backed business, which we call alternative credit. The TAM for what they address is massive. And what we're now seeing is that companies are very comfortable using private credit and private lenders. That is now developed into an asset-backed opportunity. So that's everything from consumer mortgage loan books. It can be healthcare receivables. It can be music royalties. It can be NAV loans. Just so many different underlying areas to target. That is growing massively. It's about a $50 billion business for us. That's also where we house our investment grade origination business, which is serving insurance clients. So again, lots of growth levers, even within our credit business. And the last thing is wealth. We were not in wealth again 4 or 5 years ago. We're now a top 3 player in the US. We think we're the largest here in Europe as well. We really believe in the democratization of our assets. Frankly, many own these assets through defined contribution pension plans anyway. So for them to be able to access it either on a high net worth basis or ultimately in the US, for example, through 401k, that provides a real growth path. And again, just to frame it for you, wealth is now a $66 billion business for us. We're raising $4 to $5 billion a quarter. We're seeing that expand now globally, started in the US, then Europe, then Asia. So I'd say those are a couple of growth levers for the firm.
Anyone who listens to this podcast will know that I support West Ham through good for better or worse at the moment. But I'm interested to know around kind of the sports sector.
Bowen's a great striker.
He is. That's probably all we can say. But like in terms of football or soccer specifically, I know Ares have been involved with really Atletico Madrid, Chelsea. What's the appeal there?
Sure.
And what really is interesting for you?
Sure. Well, let me take a step back and just give you the origin story a little bit. This started for the firm as a bit of a passion project in that many of us, similar to you, we are sports enthusiasts. Sometimes we'll have investments in sports businesses, et cetera, but it's sort of part of the ethos and DNA of the firm. And we had done things periodically, going back, sometimes over a decade in the space. But what changed was around COVID. What you saw was these wonderful sports teams, and I'll talk to you in a little bit about what we like. The live ticket attendance revenue literally fell to zero. And our view was a lot of them needed help to survive what we believe was going to be a temporary cash issue. And due to our personal relationships, again, this is a relationship business at the end of the day, we were first call for a lot of these really exciting, whether it was teams, leagues, et cetera, that needed some support. So that's actually how this turned into a business for Ares. We now have multiple funds and products. We have a large investment team. Again, it's not only teams and leagues, it's data, it's ticketing. We also do media and entertainment associated with it. So it's actually quite a broad mandate for us as a firm. But to go back to football, and again, I've lived in the UK for 21 years, so for me, football is soccer, not American football at this point. It's a very, very powerful business model. When you look at the revenue that's generated through long-term sticky media contracts, it's meaningful. And in particular, if you're looking at the Premier League and you're not a team that has a chance of being relegated towards the bottom, you have consistency, you have Champions League revenue. It's powerful. You've got ticketing revenue, which I'd mentioned before. You've got merchandise and branding and all these things. It's a very, very powerful business model where you also have fans like yourself who've been following these teams and are very loyal through thick and thin. I'm an Arsenal fan, and it's been a challenging 20 years for me. Maybe this is our year at the end of the day. But overall, we think that these are quite good businesses. And again, our strategy at Ares has been more around flexible capital. And overall, it's worked out very, very well. I also sit on that investment committee. So it's always fun to double click on the documents when they come across because you never know what logo you're going to see. But again, overall, these are quite valuable assets, which historically had really been the grounds for wealthy individuals or maybe benefits of league securitizations. But now that's really opened up. And there are a couple players that do it, but there are real entry barriers, I think, in particular due to relationships and experience in the space where Ares is a leader.
It's interesting you say it's kind of a relationship business. And I guess in the COVID times, were you receiving calls from clubs or leagues, kind of inbounds?
It was both.
Okay.
And again, both in the U.S. And in Europe. But again, their P&Ls or cash flow statements, were quite stressed when they just couldn't hold these matches. And even sometimes they did. There weren't people in the stands, you'll remember. So we actually generated our own loyalty through supporting them through tough times. And I think Ares also developed a reputation as a value-added partner, which serves us today, many years later.
If I think about the Ares business kind of at a high level, obviously you need to kind of ensure that there's investment return for your clients. That's number one, I guess. But a big part of the business must be the origination, kind of new business coming in the door. So how do these deals kind of end up on your desk? You mentioned you've got kind of an origination team who are obviously going out there. Are they kind of just developing these relationships so that at some point through the year they'll have a tap on the shoulder? How does that work?
In particular, Ares has invested a lot in what we call origination. And for the listeners, origination is a fancy name for finding deals.
Yeah.
It's sort of that simple. In Europe, we have over 100 people in 7 offices. In the U.S., we have over 200 people. So again, that enables us to talk to thousands and thousands of companies every year. But if I had to pin it down in a couple of key takeaways, I think the first is reputation. We've been doing this for 20 years in Europe. We've been doing it for even longer in the U.S. We are known as a well-capitalized, good partner for companies and their stakeholders to help them grow and reach their ambitions. So when you have that market reputation, sometimes things find you. But that's nothing to rest on your laurels, because the second piece, this is where you were going, is people. And it actually goes to even before they joined Ares. Let me give you an example. When we entered the European market in 2007, how did we do it? We lifted a team out of Barclays Bank, which was the number 1 mid-market commercial bank in the UK. So at that team, essentially what they said was, hi, company or owner of company, you've been dealing with me for a decade or two. At Barclays, now I'm at Ares, same guy, different business card, but the product offer that I can bring you is so much broader. The hold size is more. The process is going to be much more transparent to you and quicker. We can offer all of these advantages. So actually it starts with hiring people who've been doing leverage finance their entire careers and have really good reputations in markets. That's also how we entered the French market, the German market, the Nordics, then Benelux, then Spain, now Italy, just last year. And the third thing is after you have those relationships, you start building up a real track record. And again, we've probably transacted with 400 plus companies in Europe, by the way, with 100 plus different owners that we've done multiple things with. But the really powerful part of our business is what we call incumbency. What incumbency, again, that's another fancy name, but what it means is we have an installed base today of hundreds of companies that are growing. I mentioned earlier when we talk about screening businesses, we want businesses with real organic growth potential. And when we find these companies, we want to continue to lend to them for as long as possible. What that means is, in the UK, for example, we have a veterinary care business. We found it when it had like 3, 4, 5 million pounds of profit or EBITDA. Now it's like 150, 200 million. So we've backed it the whole time. Again, our companies are always growing. They want growth capital. They want acquisition capital. They want capital to refinance, or maybe they're being acquired by a new owner, and we want the management team to say, I've had a great experience with Ares. I want to continue with them. So incumbency is, again, another really powerful entry barrier because we know the company's the best. By the way, it's ones we decide we want to keep backing. Sometimes you know it and you don't want to continue backing it too. But by and large, again, staying with our businesses through incumbency is probably the third most important part about that origination effort.
And in the origination kind of process, just interested personally, are you going direct to companies? Are you being handed deals from kind of intermediaries? How does that split kind of usually look? Do you work direct
Sure.
or do you do both?
So honest answer is both. The core of direct lending is just that.
Yeah.
It's direct. We are capable of doing diligence, underwriting, legal documents, all of these things ourselves. So again, we cut out the middleman, so to speak. That being said, companies often have advisors, which is fine, so that they can make the right decisions for themselves. So it is also important for us to have relationships with legal advisors, accounting advisors, deal advisors, M&A advisors, again, to make sure that we're maximizing our deal flow and opportunities. I'd say we're like a little bit agnostic. We do go both ways. But what we don't do is have a situation where a deal is, say, underwritten by a bank. They're long some exposure, then they want to sell it off. That we don't do because, again, it is our goal to do all of that directly as much as possible.
Yeah, makes sense. Rating agencies within kind of the private market space, they've been in the press over the past year. So what's your view of credit ratings in the private markets, and particularly in private credit?
I love doing this on an S&P podcast, so I appreciate the question, to put it that way. Here's how I'd frame it. There certainly is a role. When you think about the origin of rating agencies and what they're meant to do, they are meant to look at a company's return characteristics and risk characteristics, and tends to be for larger companies that are liquid to give underlying investors some sense and comfort around what they're buying. In particular, in areas where, again, they don't want to make mistakes, whether it's IG or high yield or loans. Now, the private universe is a little bit different from that. And going back to what I was maybe saying a little bit earlier, we find our own loans, we do our own due diligence. We tend to be the largest owner of our loans, and they're certainly illiquid. So again, in a way, we sort of do a lot of that work up front, and also that's what our investors expect us to do. That being said, I would say in the last few years, we have seen ratings become relevant, in particular to our clients. So for example, what I said earlier on insurance companies. Obviously, insurance companies face rating agencies because, again, they have significant fiduciary responsibilities to their policyholders. So when we book investments on either insurance company client balance sheets or for their benefit, there are often ratings associated with those investments that need to be looked at. Second area are banking partners. As you may know, we tend to use credit facilities for our funds. And again, investors can choose whether they'd like to take advantage of that or not. And those banks often want some kind of rating to make themselves very confident in what they're taking risk exposures on. Again, that's also required from a banking perspective. The third thing, this is a little bit newer. Rating agencies have long been affiliated with the CLO industry that backs liquid credit. We've now seen, and we think we've been a leader in this, private CLO markets develop again, first in the US, now in Europe. And again, when you start creating a mid-market CLO and you think about tranching it up, having rating agencies involved there is obviously quite useful to the end buyers of those securities. So overall, I think that there is a role, but it might be a little bit different than what is traditionally thought of as rating agency roles in the broader credit space.
Do you think those guys, the asset owners, the insurers particularly, do you think they're kind of culturally a bit more open to dealing with someone like Ares than maybe they were in the past?
I think they absolutely are. Again, when they look at how the liabilities are forming and then what assets they need to hold against it to meet their own return on equity objectives, I would say that the alternatives portion of their balance sheet, 5 or 10% maybe, because again, they do have to run relatively conservative investment books, but what we're also able to do is create investment grade investment opportunities for them that work for the rest of their book. And I think this is what's really exciting for them because, again, what we're able to do is create IG rated investment opportunities that tend to have a slight return premium to what might be available in the liquid IG universe. Because again, we're self-originating these investments, we're structuring them ourselves to sort of create a little bit of premium and alpha versus what they might like to buy. So to answer your question, yes. I had a conversation yesterday with an insurance company CIO. It's a big part of what we're focused on as a firm.
There's a bunch of young people who watch, when I say young, I mean kind of, graduates,
right?
Who watch and listen to the show. If you were a young person coming into the world of work right now, with the disruption we have with potential AI, Gen AI, LLMs, etc., and this is, only the beginning, what kind of advice would you give them to kind of carve their way and create a career?
I'm still optimistic about young talent entering our industry and having very, very productive careers. Their day-to-day jobs might be a little bit different, but what we're looking for are people who are quite bright and creative and are systematic thinkers. They can form relationships with people and counterparties. That's one thing that I think will never be disintermediated. Now, I grew up on Wall Street 30 some odd years ago, punching in numbers. Maybe those days are a little bit behind us. So I think the key question that we need to figure out is what is the best way to train the next generation so that they can come and do Blair Jacobson's job someday in the future, when we do know that the time they'll be spending slaving over models and the like might be a little bit less than what's happened historically. I think that's kind of the key question to figure out. That being said, when I was young on Wall Street, we used to print out public filings and circle numbers and put them into spreadsheets. But that's been done by, say, FactSet or other providers for a long time. And despite that, we still have incredibly smart financial analysts on the team. So I do feel like we will find ways to continue to adapt. However, some of these real analytical skills and soft skills will become even more important. And again, if you're young in the industry, maybe your days will be more efficient, but you need to make sure that you are having the right takeaways, the right analytics to make the right investment recommendations within your firm.
It's interesting. I always think about this I've been thinking about this recently around, historically, if you get some form of education, it's typically around, a body of work or a content that you're studying, whether that's, politics or classics, whatever it might be, or maths. So if you commoditize that to some extent, let's say, I mean, personally, when I was, coming through the industry, there wasn't that much relationship training. There was maybe something on the side about building relationships. You need to make sure you build relationships. But I do wonder if the future will be more kind of relationship training driven, especially for these young graduates.
Yeah, I'd make two comments. So similarly, I'm still a big believer in education, liberal arts. I double majored in political science economics. I minored actually in art history, and here I am with an investment job. But I think what that enabled me to do was to think more broadly, more critically, and really adapt. So I think being taught how to think as opposed to what to think will become even more important. And the second piece where you were going is the EQ side of that equation, the soft skills side, I think has to become more important. And in some ways, is that born or taught? It's probably a bit a mixture of both. But what we found is it's not easy. So as we have staff that sort of migrate from junior level to mid-level to more senior level, your job changes. At a junior level, you're really crunching. You're analyzing. At a mid-level, it's more process management. Whereas at a senior level, it is more external. And not everyone is capable of making those jumps. So do I foresee more training in that regard over time as that becomes even more important? Yeah, I do. I would agree with you there.
So I think it was about 2 years ago, I had Mike Arougheti, the co-founder of Aries. He joined the podcast virtually, which was great. It was great. It was a very good conversation. You've worked with Mike for many years. Why do you think he's been so successful?
So Joe, you may know I have some unique insight into this because not only have I worked with Mike for nearly 15 years at Aries, I first met Mike 32 years ago in my first job out of undergraduate. And actually, let me pick up on a theme we were just talking about. When I joined, and again, maybe this makes some of the younger listeners feel better, I didn't know that much about finance. And I think at that time, Wall Street was taking more of a 3, 4, 5-year bet on graduates like myself, less what we would do in the first year or two. And Mike was in my merger and acquisition team. He was a year ahead of me, sort of spotted me,